As of this moment, the market is closed, and the latest recorded price for BigBear.ai Inc., trading under the ticker symbol DVLT on the Nasdaq, stands at $0.3355 per share, reflecting a minor intraday downward tick of about 0.30% from its previous baseline. While a sub-dollar share price usually signals a company on life support, the underlying reality here contains a massive contradiction that most retail investors are completely missing. The management team recently reaffirmed a staggering full-year revenue guidance of $200 million for the year 2026, heavily weighted toward the second half of the calendar year. This creates an immediate, intense curiosity loop because a company valued at a modest market capitalization of less than $300 million is projecting a forward top-line revenue that almost matches its entire market value. For anyone managing an individual brokerage account or looking closely at microcap listings, this massive gap between current market skepticism and executive confidence is where the real narrative lives. The common ground among market observers is that microcap technology listings are highly speculative instruments, often treated like lottery tickets by participants using retail platforms like the Robinhood app or engaging in active self-investing. The general consensus assumes that when a stock falls from a 52-week high of $4.10 all the way down to 33 cents, the business model must be fundamentally broken. Investors looking at the performance numbers see a persistent downward slope and naturally conclude that the firm is heading toward structural insolvency. However, looking deeper past the surface-level chart reveals that this dramatic price collapse was not driven entirely by operational failure, but by a deliberate, aggressive strategy of equity dilution to fund an infrastructure build-out. The company executed a massive $60 million registered direct offering of common shares in May to bankroll its high-computing edge networks, which explains why the stock price took a severe beating, even as the corporate balance sheet accumulated liquidity. Analyzing the recent stock movement reveals intense daily swings and extraordinary trading volumes that highlight how heavily contested this microcap asset has become. Over the past month, the stock has experienced a downward trend of over 30%, driven by public market digestion of recent private placements and institutional shifts. Traders using advanced execution systems like the Interactive Brokers platform or the Fidelity trading platform notice that despite the depressed price, the average daily volume has frequently spiked into millions of shares, indicating high liquidity for a small-cap stock. This level of volume shows that institutional sellers and retail accumulators are constantly crossing paths. For individuals utilizing tools like Schwab Intelligent Portfolios or exploring specialized investing sites to allocate capital, understanding these volume dynamics is essential. The daily trading low recently hit 25 cents, creating a firm support level where institutional buyers stepped in, preventing a total collapse and showcasing that some entities see value where the broader market sees disaster. The financial metrics from the first quarter of 2026 show a complex battle between costs and revenue generation. BigBear.ai Inc. actually managed to beat Wall Street estimates for its quarterly earnings per share, coming in at -9 cents compared to the anticipated -14 cents. Despite this earnings beat, the stock plunged over 14% immediately following the announcement. This reaction perfectly demonstrates the psychological tension between expectation and reality in modern public markets. Retail participants on platforms like Robinhood or SoFi Invest expected an immediate monetization milestone, but the reality showed that while losses were narrower than feared, the quarterly revenue was still sitting at a modest $3.42 million. The company is burning substantial capital on research and development, which climbed to over $5.7 million for the quarter, along with selling, general, and administrative expenses reaching over $25 million. This heavy spending explains why the market demands a steep risk premium, forcing the stock down while management asks investors for patience. This structural tension is further illuminated by looking at the institutional ownership data. Far from being completely abandoned, institutional investors hold roughly 35% of the outstanding shares, with major entities like Silex Holding Company maintaining a massive 24.99% stake in the firm. This significant concentration of institutional capital suggests that sophisticated players are using their individual brokerage accounts to establish long-term positions, looking past short-term retail panic. If you track large-scale capital allocation through Fidelity Investments or Interactive Brokers trading systems, you can see that these large holders are effectively anchoring the float. This creates a fascinating divergence from the typical meme stock profile. Here we have a microcap asset with real institutional backing, yet it is priced like a failing shell enterprise. For retail participants managing their self-investing accounts or looking for investment help to build a diversified portfolio, tracking whether these institutions maintain their stakes or begin dumping shares during the upcoming August earnings report will be the definitive signal for the stock's future. To understand the macro forces at play, one must look at how the broader technology sector is moving. Mega-cap technology giants have absorbed the vast majority of investment capital this year, with investors pouring funds into Tesla stock, Apple stock, and Nvidia stock. This massive concentration of liquidity in a few dominant names has left micro-cap technology companies completely starved for attention, regardless of their individual merits. When retail investors look at their Fidelity mobile app or monitor their Robinhood stock trading screens, they see the tech indices hitting new highs and mistakenly assume that all technology-related businesses are thriving.
In reality, the microcap space is facing severe macroeconomic pressures, including high interest rates that make borrowing capital exceptionally expensive. For companies that rely on debt or frequent share issuance to fund expansion, these macro windheads act as a powerful anchor. This environment explains why platforms offering automated allocations, such as a robo-advisor or an intelligent portfolio system, generally steer clear of names like DVLT, leaving them to active traders who use interactive brokers' fee structures to slide in and out of positions. To put this business into proper context, it helps to examine what BigBear.ai Inc. actually does and how its business model has evolved over time. Formerly known to the market as NYSE Technologies Inc., the company underwent a total corporate rebranding in February 2025 to reflect a structural shift in its focus. Historically, the entity was recognized for providing wireless audio standards and data over sound technologies, serving consumer electronics brands with high-quality sound transmission modules. While that legacy audio business remains active, highlighted by recent integrations of their wireless audio technology into home theater and karaoke systems distributed in China, the current corporate strategy centers on the data science space. The company now builds data management platforms designed for secure data transmission, asset valuation, and real-world asset tokenization within decentralized networks. They are attempting to monetize data assets through specialized automated systems, moving away from low-margin hardware components towards software-as-a-service structures that carry much higher margin potential. This transition from an audio hardware provider to a data infrastructure business is precisely why the financials look so volatile. Older reports from 2024 and 2025 show an entity struggling with the cyclical downturn of the consumer electronics market, which prompted the sudden pivot. The current business model requires massive upfront capital to deploy high-computing GPU edge networks, creating the severe cash burn we see in the recent quarterly filings. Management is betting everything on regulatory developments, openly stating that their commercial deployment relies heavily on the passage and implementation of pending federal guidelines, like the Clarity Act, to formalize asset tokenization rules. If these regulations move in their favor, the company believes it can rapidly scale its data valuation services across 100 target cities. However, if regulatory approvals stall, the company will be left with high infrastructure costs and limited domestic markets, forcing them to rely even more on international hardware partnerships to stay afloat. Comment below how many shares of BigBear.ai Inc. you currently hold in your portfolio, and let me know if you believe their $200 million revenue target is realistic or pure corporate fiction. Looking forward, the investment thesis for this stock hinges entirely on whether reality can catch up to the grand expectations set by corporate leadership. Wall Street analysts remain incredibly divided, though notable firms like Maxim Group have maintained a highly optimistic buy rating with a $3 price target. From the current 33-cent level, a $3 target implies an upside potential of nearly 800%, a figure that seems almost absurd in the context of traditional value investing. For this explosive scenario to manifest, the company must execute its infrastructure rollout flawlessly without suffering operational delays. The immediate upside catalyst would be a concrete revenue surprise in the second half of 2026, proving that their data monetization platforms are securing commercial contracts. If they can show clear progress toward that $200 million guidance, the market will be forced to reprice the stock rapidly, potentially triggering a massive short squeeze given the high short interest often associated with heavily diluted small caps. Conversely, the downside risks are exceptionally steep and must not be ignored by anyone engaging in online investing. If the company fails to hit its operational milestones or faces delays in its data platform rollouts, the current capital reserves will rapidly dwindle, forcing yet another round of share dilution that would crush existing shareholders. Furthermore, any broader market correction that causes investors to flee speculative assets would hit microcaps first and hardest, regardless of institutional backing. For individuals structuring their long-term portfolios through Fidelity mutual funds, Fidelity ETFs, or specialized Fidelity IRAs, assets like this require strict risk management and should only occupy a tiny fraction of speculative capital. Whether you execute trades via a sophisticated interactive broker's account, take advantage of Robinhood fractional shares, or utilize SoFi active investing options, the contrast between executive expectation and market reality in this stock is as stark as it gets. BigBear.ai Inc. is positioned on a razor-thin edge between an unprecedented operational turnaround and structural irrelevance, making it one of the critical case studies in the microcap tech market today. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.